as you can see on the main slide, my name's Gill Yates and I'm Head of VAT Services at VAT Penalties. And I'm going to give you a bit of a talk about VAT. Now clearly all VAT inspectors are not aliens, but sometimes it does seem like that, because it does seem like they don't speak, not just English, but any sort of human language. Can we turn the volume? Is that better? Right, can everybody hear now? Excellent, right. As I was saying, all VAT inspectors are not actually aliens, but sometimes it does seem like that. And I feel comfortable saying that because I used to be one. And I know I didn't metamorphosise into a human being when I left what was then Customs and Excise. But I think sometimes it seems like they're talking a different language to taxpayers, so that's why we've got that headline up there. So, the agenda for this talk. I'm going to talk about the consequences of not informing HMRC of a change in your client's details, prompted or unprompted disclosures in terms of how HMRC see them and how it affects penalties, the importance of checking what HMRC say to you, flat rate schemes, deregistration pitfalls, capital item schemes, and we put a question mark for the last one, a change in approach by HMRC and advisors. Because what we're really looking at there is, given the world that we're living in now, and HMRC being, we believe, a little more aggressive in terms of wanting to get money from us all, do advisors need to change the way that they respond and deal with HMRC? So that's basically what the agenda's for. If you've got any questions, because we've got an awful lot of things that I want to cover and we want to give you value, if you could leave them and come and see us on our stand afterwards, then we won't spend 15 minutes talking about something which is fascinating for one of you, but everybody else is thinking, I'm not really interested in this. We're on stand A438 if you want to come and ask questions later. Okay? Right, so moving on then. Changes in client details, and we're doing a bit of a case study for this because we think it's easier if we give you a real life situation. We had a client who was a sole proprietor, well, when I say client, an accountancy client of ours had a client who was a sole proprietor who incorporated but forgot to tell HMRC that they'd done that. I think most people in the room know of somebody who may have done that at some point. The company, this is quite common, accounted for and paid VAT under the VAT number that the sole proprietor had used. And no problem, they believed. You know, they paid over all their tax. What was the problem? When HMRC found out that they'd incorporated, they actually slapped a penalty onto them for a failure to notify the change of circumstances. Now we've got up there £5,000. Actually, the initial penalty that HMRC went for was much higher than that. Much higher than that. And this is in a situation where there was actually no tax loss whatsoever. Now, as a taxpayer and not a VAT advisor, I'm not entirely convinced that that's what I would prefer HMRC to be doing. You know, I'd rather they were out taking lots of money from people who hadn't actually paid tax at all or hadn't paid enough. But we have found out that this is not an isolated incident. We're actually, at the moment, proceeding to VAT Tribunal at the moment with regard to this particular case, and we know that there's other cases because we're actually standing behind somebody at the tribunal. There's somebody else who's the lead case, so we know there's at least one other out there, and I suspect there's going to be quite a few. In the past, HMRC did not ever go after penalties in this situation. They've always had the legal ability to, but they've never really done it. I mean, I've been doing VAT far longer than I'm going to admit to anybody in this room. But the truth of the matter is, I think this is the first time in my whole career, actually going back to when I was in HMRC, that I've ever known this begin to happen. And I think it's a sign of the times. I think it's a sign of the need that the department has to collect money. And they're doing it because they can. But it's something that you all need to be aware of, and I think those of you who are accountants in the room, of which I suspect there's quite a few, you need to make sure that you're having regular discussions with your clients to let them know that they need to tell you about things before they do them. So you can help them to get all their ducks in a row and all the necessary forms filled in and get their VAT registration appropriately titled in the right legal entity. In these circumstances, it would have been a transfer of a going concern without any doubt. But in this, this particular client's in a situation where at the moment they are facing a penalty. And it's a very, very simple thing for them not to have done because they've actually paid the full amount of tax, but just within the wrong legal entity. Now, the law says the taxpayer is required to notify any changes to their circumstances to HMRC within 30 days of the change taking place. And you've got to ensure that HMRC is advised of all changes within this timescale to avoid penalties. And that is now being enforced. Certainly with regard to the situation I've just explained, where there's a change of legal entity. I've not yet known them go after somebody if you've changed your address, but who's to say that they won't? So just a bit of food for thought, actually. A nice gentle starter for what's to come. Now I've put this in because this is a fairly recent VAT tribunal case, and I put it in early because I can say gastroenterology at this stage of the talk. In 40 minutes time I might not be able to pronounce it properly. But it was a case for, as it's got there, the UEGF. And what happened was they made errors across 3 VAT returns. They were in a situation where an agent actually issued their invoices for them, and there was a miscommunication, shall we say, with regards to information. And the VAT that was due was charged on the invoices, it just wasn't put on the VAT returns by another agent who was filling the returns in for them. They were in a situation where HMRC contacted them to say we want to come out and do a visit. And around that time, their advisors, having looked at all the bankings and all the income and all the other records, thought, whoops, there's a mismatch here between the VAT returns and what we know from a cash point of view. And what happened was the particular business in this situation said, we don't think we should have to be penalised because we told you before you came out for the visit that there was a problem. And what HMRC said, and the tribunal agreed with them, was, you may have done, but you told us after we'd arranged to come out and do a visit. And in terms of strict timing, that's true. So it's a really good reminder in these circumstances, because I think a penalty of £105,000 is a pretty big lesson. But you have to be checking, I think, on a quarter-by-quarter basis what you did last time and whether you think there are any errors, and you must disclose them as soon as you think there's a problem. If in doubt and you think that there's a problem and you can't quantify it yet, write to them and say that. At least put them on notice that there's an issue, because you've got a much better chance of protecting yourself against a penalty if you do that than if you wait for them to ring up and think, oh, I better have a look and see if there's anything I might need to tell them about, because it's invariably going to be too late at that stage. So it's just something for people to ponder on. This one I had to put in. If you want a copy of these slides later, by all means pop by the stands, give us your email address and we'll send them to you, so that you can see that photograph close up, if nothing else. This was an assessment issued to a small cafe for, as you can see, 979,092,858 pence. Your average cafe would struggle to actually be owed that in VAT. I don't know many businesses anywhere in the world that could owe that for VAT. And which we put there, if you paid over £1,000 a month, if you came to some sort of arrangement, it would take you just over 81,000 years to pay back. Now this on the introduction slide was the one where I said, be sure to read the paperwork that HMRC send you. Some people, and I know none of you in the room would be guilty of this, but I think some of your clients might be guilty of this, don't like opening brown envelopes. Or if they do open the brown envelopes, they don't really read the letter, they just look at it and think, oh, that's the tax, I'll look at that later. If this lady hadn't looked at this fairly quickly, she would have had bailiffs turning up to a small cafe, potentially, and finding out that there wasn't an awful lot to cover that sort of amount of money to take away. But they might have got a nice egg and bacon sandwich out of it. But the real point here is HMRC send out an awful lot of correspondence. And that means the odds are some of it will be inaccurate. And that's even where, it's in this case, where clearly the computer just had a bad day. Quite often, they'll send out paperwork where they think the amount of money that's due is accurate, but it just isn't. In the last figures that we've got available, over a third of the initial assessments that were sent out for VAT were over-returned on internal review within HMRC. Never mind when other people got their hands on things. So it is always worth querying amounts, it's always worth checking. It's always worth finding out why HMRC believe that that amount of money is due. And if you can't argue with them, then that's what people like me are here for, because we can tell you whether there is a way that you may not have to pay that VAT legally or not. And if nothing else, if it gets to a penalty stage, we can almost certainly help you to mitigate that. But it is just worth bearing in mind. From interest, when the lady got onto the telephone after she'd had a conversation with them, the amount went down slightly to nearly £17,000. Which is more in line what potentially could happen with a small cafe. But it's just worth, I mean, if you think that an amount of money is due to HMRC, don't accept the first number that they put on the piece of paper. It might not be accurate. Moving on to the flat rate scheme. Who in the room's got clients who operate the flat rate scheme? How many people think they understand it fully? Oh, we've got one person. Well, you can come and do this bit if you want. We are getting quite a few cases now where HMRC is challenging the business sector that's been chosen by businesses and then backdating the application of a higher rate. To date, I haven't seen a case where they've actually said, no, you should be on a lower rate. But I live in hope. So it's worth checking the rates, and it's worth checking that the classification is correct. When you apply to join it, write to HMRC, this is our advice, telling them why that sector's been chosen and saying to them, if they don't agree with you, could they let you know? Because that gives you a little bit of protection should they come along and disagree with your choice. Because at least then you can say, well, we did ask you, we did tell you what we do, and you didn't contact us. In my experience, they don't generally contact you. They're too busy sending out letters for billions, nearly £1 billion to people. But it's worth doing because it gives you a level of protection. If anything ever did proceed to internal review, or worse than that, to tribunal, it means you've got on record that you did actually try and clear it. If any of you have ever written recently to HMRC asking for a formal opinion on anything, has anybody ever actually had a letter back where they've actually given you clear, unequivocal advice? I don't think I've had one since about 2001. So you probably won't get a response, but it doesn't mean you didn't try, that you didn't notify them of the correct circumstances. Another case study now, because we found that these are quite popular with people. You've got a business that's operating the flat rate scheme that decides to sell a property which it's no longer using and upon which it didn't ever recover any input VAT. The sale is a VAT exempt one, as the property is more than 3 years old and there isn't an option to tax that's been made on the property. It's not within the capital goods scheme. That means it's got a value that's below £250,000. So, what is the potential result from a VAT point of view of that sale? Because under the flat rate scheme, exempt supplies are included within the turnover, VAT applies to all the sales that are made under the flat rate scheme. I suspect that if you have clients who are ever in that situation, they will not be happy about paying VAT which they haven't received from anybody. So, looks like the slides have gone out of order. But basically, in those circumstances, what we would advise people to do is to consider coming out of the flat rate scheme before they sell the property. Once you come out of the scheme, you can't go back in within a year. But that may be better for you from a VAT point of view, from a financial point of view, than actually having to pay VAT on a property that you haven't charged VAT on, in terms of your customer paying it to you. So it's worth, this is another example where it's worth talking to your clients if you know that they're potentially going to be selling a property, to advise them about what the possibilities are and just do the maths in terms of the money. For most, I think it would be worth coming out of the flat rate scheme. Moving on to deregistration. This is a situation where people get themselves into all sorts of muddles, in our experience, and quite often get letters saying, you owe us money on. I've got a client at the minute who didn't realise that if they deregistered and they got an opted property on their hands, that HMRC would want a lot of money off them. In our particular case, it would be about £120,000. And they very, very, very nearly have had to pay that. They came to me after their previous advisors hadn't told them about the consequences of deregistration, so they did deregister. And then HMRC came along and said, we'll have that amount of money off you. And they came to me and said, please help. Now in this particular circumstance, we got fortunate because HMRC hadn't officially deregistered these people on their records. So I've been fighting to reinstate them to VAT registration ever since. And it looks like it's going to work. It looks like we're getting there. They will have to still pay VAT on some of their supplies, but it's an awful lot better than having to pay £120,000, which they haven't got, and actually being made bankrupt. So it's worth remembering about the fact that you have to account for VAT on assets that you've still got on hand when you do register for VAT. We've got listed here all the different sorts of things which are defined as assets for the purposes of deregistration. And as I say, we're more than happy to send you a copy of these slides if you give us your details. but there's quite a few. Again, further things. As you can see, land and buildings obtained VAT-free come into it. So what about properties that are refurbished, renovated or extended, where an option to tax has been made? Is VAT payable on deregistration? We think not. And the reason that we think that is because if you've had a refurbishment or a renovation or an extension, what you've bought is services. You bought the services of a builder, and a carpenter, and an electrician. And in those circumstances, because it's a supply of goods that you've received, the services that you received are not goods, we think that that means that you don't have to account for VAT in those circumstances, because you haven't actually incurred VAT on the purchase of goods. You've incurred it on the purchase of services, which is different. I know you've got a bigger building at the end of it, but I never said that VAT was totally and utterly logical. And in fact, our managing partner accuses me once a month of dealing with a tax that's completely illogical, and that and she frequently tells me it's weird. And she's sort of right. As I say, unless new goods have been created, it's our view that the property on hand at deregistration does not fall to be treated as assets upon which VAT should be paid. But, and how many people when they're speaking to VAT advisors have heard but? That or it depends are the two words which my managing partner tells me that she wants me to put on my gravestone, things I say the most. If you have a capital item is an item which is a value of over £250,000. And they're selling this building is a capital item, and they bought it 5 years ago. They paid £500,000 plus VAT of 87.5 because VAT was paid at 17.5%. They didn't opt to tax the property because they were a fully taxable business. That means they could recover all their VAT. They charged VAT on everything that they did. So they didn't need to opt to tax the property to be able to recover VAT. So they didn't. And in all honesty, if I got a client that was a fully taxable business, I wouldn't advise them to opt to tax when they first bought a property because they don't need to. So when they come to sell the property, the sale is a VAT exempt one, because the building's more than 3 years old. New buildings, for VAT purposes, are subject to VAT, but they stop being new when they're 3 years and a day old within VAT legislation. And there's no option to tax in place, so it's an exempt sale. The solicitor who's dealing with this says, are you happy that the sale can proceed without VAT? Who would say yes? Who would say yes but daren't put the hand up? It can only go ahead as an exempt sale if the client wants to pay HMRC some money. And the reason for that is because the capital item scheme measures the use of a building over a 10-year period. And if the building costs, as we've got down there, at least £250,000 to purchase, build, extend or refurbish, it's included within the capital item scheme. The client used the building when they were occupying it for 5 years to make fully taxable supplies from. So they've had 5 years of fully taxable use. But if they sell it after that 5-year period, the remaining 5 years is treated as exempt use. But it all comes in one go. So the result is that they would have to repay half of the VAT that they originally recovered. Now, I've been in situations in the past where I've had a client I've just saved from that, or being in a similar situation. I've been in situations where clients haven't told us that they were selling a property, and we've been in the unfortunate situation where HMRC have said, you owe us some money and there's nothing I can do about it. It's too late. But I would bet in those circumstances that when they've decided how much they want to sell the property for, they haven't factored in the VAT that isn't going to be remaining with them and that they've now got to pay back to HMRC. So in those circumstances, if it's at all possible, our advice is opt to tax before the property is sold. In the current market, I think most commercial properties seem to be subject to VAT now anyway, 20 years on or so since the options tax was introduced. So it shouldn't, for the majority of purchasers, be an issue unless they're going to use the property for an exempt purpose. If you can't opt to tax, then factor the fact that you've got to pay some input tax back to HMRC into the sale price. Now, I've put this up because it seems to me at the moment that HMRC are updating public notices virtually every day. I can think of at least 14, 15 that have been done in the past 4 or 5 months. The problem is that they don't publicise that very well. So if your clients or you have got a copy of a public notice, well, if you've got one that was printed that you didn't download, then it's almost certainly out of date because they haven't issued printed ones for an awful long time. But it could be that you downloaded a version of a public notice only last week and this week it's out of date. So if you're going to use public notices and rely on them in terms of either preparing VAT returns or giving advice, please check on the website that the version you have is the current version. The other thing you need to do is probably read through your old copy, read through your new copy and see what the changes are. Because although quite often they will put HMRC will put what they consider to be the most significant changes on the front page, in our experience, what they consider to be significant and what we consider to be significant is slightly different. And I have seen 1 or 2 changes made where I thought, I didn't know about that. Now, okay, the public notice in most cases isn't law and it doesn't replace the law, but it is the view that HMRC take in terms of how the law is going to apply. And if you're relying on what's in the public notice, you need to know what the current thinking is. You need to know whether you agree with it. Now we've put, there's no communications other than on the HMRC website. That's one of the downfalls actually of not submitting VAT returns in a physical form anymore. It used to be that when you got your VAT return, you got sent a VAT notes leaflet. Now I know an awful lot of people didn't read them, but they did give details of things like this, of changes that have been made to public notices, new public notices that have been brought out, important business briefs even. But that doesn't happen anymore because there's no physical VAT return sent out anymore. So really, unfortunately, and I hate to be the bearer of bad news to you all because I know that you've got plenty to do already, but you really, really, really will have to check each time on the website that the public notice you're reading is the current one. Now, moving on to the last slide here. Is there anybody in the room who hasn't noticed when they're dealing with HMRC that there's been a slight shift in their attitude? I deliberately phrased it that way because I knew you'd all put your arms up if I asked it the other way. We certainly have. In our experience, we found that in circumstances where previously, when HMRC had been out to see a client, they would have had a dialogue with you if they had any issues. And they would have had a dialogue until it was quite clear that neither side was going to change their mind. And you'd be allowed to submit further information, they'd give further clarification if you requested it. You felt like there was a potential chance of avoiding an assessment being issued, or at least influencing the quantum of an assessment that was going to be issued. In our experience, that's just not happening anymore. Nowhere near as much as I wouldn't say it never happens, but it's not happening to the extent that it once used to do. We have found lots of circumstances where assessments have been issued first, and the difficulty with an assessment being issued first and then having to fight it is that you're then in a situation where HMRC have got to withdraw something. And that's never the same. It's never as easy as getting them to not issue it in the first place. Because once a VAT visiting inspector have nailed their colours to the mast, and I can say this from personal experience because I know how I used to feel. And my colleague David, who works with me, he was a VAT inspector also. But we're reformed now, honest. But he was a VAT inspector, and he said the same thing. You sort of don't want to have to change your mind, because that's human. So what we're finding is that they're issuing assessments first, and one of the problems that we've got is that the VAT appeals process changed when we went to unified tax tribunals a few years ago. Prior to that, if you went to a tribunal and you won your case, there was an exceedingly good chance you would get your costs back. That's not true anymore. Now, you will only get your costs back in very, very limited circumstances. Genuinely, it will be when it's considered to be a very, very complex case. So very intricate reading of the law involved, very complicated from a legal perspective. You will also get your money back if the assessment is clearly, and this is a technical term coming up, utterly barking in terms of whether it could be applied or not. If it's clearly specious and couldn't remotely be considered as being accurate, if you went to tribunal in those circumstances and won, you would probably get your money back, you'd probably get your costs back. But other than that, the chances are that you won't anymore, even if you win. And one of the problems with that is it means if somebody's got an assessment for, say, £5,000, and they think that they could incur costs of, say, £1,500, £2,000, going to a tribunal, that essentially means that they've got a chance of having to pay £7,000 and not winning, or essentially only getting £3,000 out of it once they've met their costs. And this, we think, is adjusting people's views about whether they want to go to tribunal at all, whether it's worthwhile. And I don't believe that it's necessarily a conscious situation with regard to HMRC, but I do wonder if there's the odd officer who is thinking, well, if I bung the assessment out, the chances are they won't fight it, because it won't be worth it. And in all honesty, I think there probably are quite a few taxpayers who pay up on that basis, not because they think that the assessment is correct, but because they think it's going to take too much time, trouble and money to fight it. And if it's a cost that they can just about bear, they may well just pay it. So, that being the case, what do we as accountants and advisors need to do about it? And I think the key here is a twofold approach. The first thing is, I think it means that we need to be even better about talking to our clients on a regular basis and finding out what they're doing, being as knowledgeable about their business as we possibly can be, so that we can work out whether they've got a potential VAT issue before HMRC come along. They're in a position where they will come to us before they've got a VAT visit, and we can make sure that their VAT affairs are correct, having taken advice either from HMRC, from yourselves, or from people like me if you think it's something that you prefer a bit of assistance with. In those circumstances, the chances are you will not be in a position where you've got the VAT situation wrong in the first place. And I know that people would say that is what I would say, but in all honesty, I think that is the way we're going in terms of people avoiding assessments and basically hassle and aggravation, if nothing else, from HMRC. The other thing you can do is, once you've come to a decision about what you think the correct liability is, and generally people make mistakes on things that are unusual transactions for them. So if they don't normally export, that it's an export. If they don't sell property very often, it's a property query. When people are doing something that's unusual for them, that's when they can tend to make errors. And that's when they need to be absolutely sure that they do whatever they can to protect themselves. Once they've come to a decision about what they think the correct answer is, we would advise that they put the full facts of the matter in writing and write to HMRC, telling them what they're doing. Now obviously that's what you do if you don't want to come to us and get the answer definitely right. But we believe that, again, although that doesn't give you necessarily cast iron legal protection, at least you've had then put something to HMRC and saying, this is what we are doing. If you disagree, and we've given you the full facts to disagree on, let us know. We believe that if it ever did then go to an internal review or to a tribunal, you put yourself into a much better position. Because HMRC in those circumstances cannot say that you didn't try. I don't generally advise using the helpline, and that's nothing against the people who operate the helpline. They're normally very helpful people when you get them to answer the phone. But the problem is, the advice that they give is only as good as the questions that are asked. And what they generally don't do is the first thing that most of us do, which is say to a client, why are you asking the question in the first place? What's the whole picture here? Advice given on the basis of a small amount of information, which is what the client genuinely thinks is irrelevant information, isn't necessarily reliable, because in all honesty, the majority of my clients don't know what the information is that I need in order to give them the best advice. And that's the problem with using the helpline. The helpline will generally answer the question that you've asked, but how many of you have conversations with clients where you think, actually that isn't the question you should have asked? I mean, I do that on a daily basis. So our advice is, we think we need to be much, much better at getting clients to be proactive about getting advice. And that basically means us all being in contact with the clients to encourage them to talk to us before they do things. Because I don't think that once the country is out of the financial position that it's in at the minute, that HMRC are going to change their attitude on this. I believe that the inclination to issue assessments earlier than they once would have done is with us to stay. Because I don't think that they're staffed to deal with situations in any other way. I really, really don't think at the moment they've got enough staff to actually enter into a full dialogue. It's a time-consuming process. So unless that were to change, and of course it could, I think they've got issues. So hopefully that's given you some food for thought. By all means, we would encourage you to pop along to our stand, give us your details. We'll answer any questions that you've got. Our stand, as our marketing manager is holding out to me, is A438. Sounds like a raffle ticket number, but it's A438. And we'll be more than happy to send you a copy of the slides if that's what you want, or to give you any advice that you need. And thank you very much for staying awake and listening. Thank you.